Welcome to another episode of PwC's Boardroom Forum Live. Today the discussion will be focused on IFRS reporting, in particular IFRS 19, the newly issued disclosure standard focusing on subsidiaries without public accountability. My name is Diphti Govind, and I'm Senior Manager in PwC's Corporate Reporting Services. Today I'm joined in conversation by Ronel Fourie, a partner in PwC's Corporate Reporting Services, retail industry specialist, and IFRS for SMEs expert. Welcome, Ronel. I'm looking forward to hearing the insights from you on IFRS 19.
Hi, Diphti. I'm looking forward to our discussion.
IFRS 19 was recently issued by the International Accounting Standards Board, and by its title, has to do with subsidiaries. As I was preparing for this session, I was thinking that there are other IFRS standards that deal with subsidiaries, such as IFRS 3 business combinations, IFRS 10 consolidated financial statements, which also focuses on control. Can you summarize the scope of IFRS 19 and who actually is in the scope of the standard?
That's a good question, Diphti, and I think it's all in the title, as you said. So the title is Subsidiaries Without Public Accountability, Disclosure. So who is a subsidiary without public accountability? Well, a subsidiary without accountability or public accountability doesn't have listed debt or equity, and neither does it have assets that it manages in a fiduciary capacity for outsiders. So that's typically a bank or an insurance company. So if a subsidiary has a parent that provides or prepares information that's publicly available in terms of full IFRS, that subsidiary might be eligible to apply this standard. But in the second part of the title, it's about disclosure. So this standard is only available for that subsidiary to the extent that it provides disclosure in terms of IFRS 19. So recognition and measurement, as well as presentation, in other words, your primary financials, your balance sheet, your income statement, those are still in terms of full IFRS. But all the note disclosures are in terms of IFRS 19.
This sounds like a welcome change for group entities, particularly to simplify the preparation of subsidiaries' financial statements. And I also understand that this is a voluntary standard. And in the world of full IFRS reporting, we continue to see disclosure requirements being added on in terms of amendments that are made to standards, etc. So it would be interesting to understand what the board's approach was to now develop a disclosure-only standard, and that too with reduced disclosure requirements. Ronel, do you have some insights from the standard setters lens on this approach, as well as what the objectives of IFRS 19 are?
Yes, Diphti. So what the board sets out in their decision-making around the standard is that these subsidiaries still need to produce information that's useful. But I suppose, users are a different set of users to that of its listed holding company. So this subsidiary is not looking for capital markets investment because it's only, or in most cases, it's controlled by this holding company, and the users are pretty much internal to the group. But nevertheless, the information has to be useful, cost-effective, though, so that was one of the objectives, cost-effective, and also simplified. So they were really trying to simplify disclosures for these subsidiaries. So what the board did is they set out a couple of objectives in looking at what users of these financial statements are interested in. So typically they're interested in short-term cash flows. So what are the obligations? What are the commitments of these entities? Are there any contingencies, perhaps, where these entities might need to pay or have expenditure that they need to incur in the future? They were also looking at, or the users of these financial statements are also looking for information about accounting policy decisions that the subsidiary has made in order to align group policies. They're also looking for information on liquidity and solvency, because in many instances, I suppose, dividends are paid out of these entities up to the listed group, and that is what's then available for the listed group to distribute. Something else that the users are looking for is disaggregated information to really help them understand the detail within these entities. So those are the objectives of the board: simplified disclosure, cost-effective disclosure, but still disclosure that's useful. So where did they start? Well, they started by looking at the framework for IFRS for SMEs. Because in fact, the definition for publicly available was borrowed from IFRS for SMEs. So what is required for an SME entity would also be required for a subsidiary without public accountability. So that's really their starting point. But as you mentioned, it's purely a voluntary standard.
Thanks for those insights, Ronel, especially with regards to the link to IFRS for SMEs. And considering that this is a brand new standard, looking at it through the lens of a preparer, is there a practical example you can perhaps share as to how an eligible subsidiary can go about applying the requirements of IFRS 19?
Yes, so that's I suppose, the million-dollar question is, how do we apply these simplified requirements, and are they truly that simplified? So what the board did in preparing or setting out the standard is, from each and every section, they removed the disclosure objective. So what that really means is that without a disclosure objective, an entity doesn't have to take a stand back approach to look if the information that they're presenting is complete and really tells a story. They can merely apply or comply with the requirements within IFRS 19 without providing additional narrative. So what the standard, I suppose, simplifies is you don't have to provide more context to movements or significant judgments in the attempt to simplify the disclosure. But there are still quite a number of disclosure requirements that you have to comply with. So it's really a comparison approach. What does full IFRS require, and where can you use a red pen to scratch out some of these disclosures because they're no longer required in terms of IFRS 19. Now, practically, I suppose, if we look at one of the standards that are pretty common, IFRS 15, for revenue recognition, there's quite a bit of complexity often around identifying or determining how to recognize revenue or when to recognize revenue. So an entity recognizes revenue over time based on an input or output measure. What IFRS 19 requires, for example, is that you describe that input or output measure, as opposed to giving context to your significant judgment in applying that disclosure requirement or that measurement requirement. So a lot of the significant judgments, narrative, explanations are reduced within IFRS 19. So as I mentioned, it's really a comparison. You're going to use full IFRS, take your red pen in what's no longer required to be disclosed in your subsidiary. And we're bringing out a document around October on our Viewpoint site that will provide insight into that. It will give you the full IFRS disclosure and grey out the sections that have been removed to assist preparers to go through that process and identify where they can reduce disclosure. So I really hope that's going to be a very useful document for entities or for preparers to set boundaries or change their templates for disclosure. I think we'll touch on groups a little bit later, but there's a little bit of a snag that I'd like to chat to you in group reporting.
So in other words, Ronel, you're saying that it's not actually the silver bullet that everyone was, perhaps expecting or hoping for, but IFRS 19 may simplify reporting obligations and costs while maintaining usefulness of the financial information. However, companies would, still need to think about, factors in their transition process. And I think that brings us along nicely to the next question, to say that, is there a transition cost factor to consider? And the key question is, what is the timeline for adoption of the standard?
Yes, Diphti, I think I would echo your first point, is it's not the silver bullet that companies might be expecting. For example, everyone's first question is about financial risk disclosure. Unfortunately, that is still there to quite a large extent. So maturity analysis, credit risk disclosure, the inputs into your credit risk disclosure, all of that is still required. So it's not a silver bullet, it's not a no disclosure standard, but within the boundaries of being useful to the readers of that set of financial statements. Now, your question about transition. So the standard is effective from 1 January 2027. It is available for early adoption, though. And it's voluntary. I think we can highlight that again. It's certainly not required to be adopted for any subsidiary. But if they are in scope, they can voluntarily adopt the standard. One of the things to consider, I suppose, from a cost perspective, and it's perhaps an interesting point and a reflection also on the board's perspective, is they were also looking at multinational groups in which entities were applying local GAAP standards within certain territories. Now, this local GAAP might have different measurement requirements or recognition requirements. So essentially, these entities had to keep two sets of books, one for the local GAAP and one for IFRS, that then consolidated up into the group. So the idea of this reduced disclosure standard is that the subsidiary would only keep one set of books, the IFRS set, with then reduced disclosure, or the benefit of reduced disclosure. And that would certainly be more cost effective. In South Africa, though, we're moving off of a base of full IFRS. So every group should really assess whether it is more cost effective for them to apply the reduced standard or reduced disclosure standard. One of the key things to remember is, if a subsidiary has complex transactions where there are critical judgments or additional narrative required, that might actually be required within the group entity or the consolidated listed entity disclosure. So somehow this disclosure must still flow up to group, whether it's in a group reporting template or in some other way. So it's not as if this disclosure is going to just disappear, even though it's not presented within the subsidiary entity's financial statements. We have seen, for example, in territories like Australia, where they follow an endorsement process, that they're still considering whether they will endorse the standard or not. So it might not be something that an entity can adopt voluntarily within all the territories that it's operating. In South Africa, it's already available for adoption, though.
Thank you, Ronel, for sharing those practicalities as well as realities in transitioning to IFRS 19. And what you've mentioned can already be tangible aspects that companies can start working towards ahead of 1 January 2027. That brings us to the end of yet another insightful discussion capturing the highlights of IFRS 19, a voluntary standard focusing on subsidiaries without public accountability. Thank you, Ronel, for sharing this time with us.
Thank you, Diphti.
Thank you to everyone who has listened in to this session. Join us for our next Boardroom Forum live session, where we will be discussing and navigating the challenges practically for IFRS 16 leases.